For decades, the world of finance has basically been this huge tug of war between two big ideas: the old school's art of picking stocks versus the modern theory that says you just can't beat the market. Today, we're diving into a paper that actually tries to build a bridge between them, offering a whole new economic foundation for that age old practice of security analysis. And really, it all boils down to this one massive question. If the markets are supposed to be so efficient, how in the world do legends like Warren Buffett consistently come out on top? Is it some kind of financial wizardry, pure genius, or is there something deeper, something systematic that we've been missing all along? All right, so here's how we're going to tackle this. First, we'll get into the big debate that basically split Wall Street in two. Then, we'll look at a new theory and this cool model called Q5 that says it can finally connect those two worlds. After that, the fun part. We're going to see if this model can actually explain away the magic of some legendary investing strategies. And finally, we'll land on a completely new way of thinking about what it even means to be a great investor. Okay, let's dive right in. At the absolute heart of modern finance, there's this fundamental clash of ideas that has pretty much defined the industry for almost 100 years. So in one corner, you've got security analysis, the school of thought from guys like Graham and Dodd. They taught that investors need to be like detectives, hunting for clues and digging deep to find undervalued companies that are selling for way less than they're truly worth. But then, in the other corner, you have the efficient markets hypothesis. This is the bedrock of modern finance, and it says, nope, sorry, all the public information, it's already baked right into a stock's price, which makes finding those amazing bargains consistently pretty much impossible. And Graham and Dodd had this absolutely brilliant way of putting it. They said the market in the short run is a voting machine, basically a popularity contest driven by feelings and hype. But in the long run, it's a weighting machine, a scale that eventually has to recognize a company's true fundamental value. And it's that gap between the voting and the weighting that a security analyst lives for. That's their hunting ground. So, how can both of these ideas be right? They seem totally at odds with each other. Well, this is where our source paper introduces a really fascinating new theory that tries to finally, after all these years, bring these two camps together. It's called the Investment Capital Asset Pricing Model, or Investment CAP. Okay, but here's the big twist, the thing that changes everything. Almost every other theory looks at stocks from our perspective, the investor's perspective. What are we willing to pay? This model flips that completely on its head. It prices stocks from the company's point of view. Think about it. When a company's management decides to invest $1 of their capital, they expect to get a certain return on it. This model says the stock's price should actually be driven by those expectations and decisions made inside the company. So you might be asking, okay, so what? Well, that simple flip in perspective leads to something pretty remarkable. The theory predicts that the highest stock return should come from companies that are super profitable and growing, high quality, but that aren't investing a ton of new cash. Now, why is that? Well, if a really great company isn't investing heavily, it kind of implies the market isn't giving them a stock price that's high enough to justify big new projects. And that's the signal. That's the sign of a potential bargain. So what this does is provide a solid economic reason for the exact philosophy of Graham and Dodd: buy quality companies at a good price. Okay, a theory is one thing, but can you actually test it? Does it hold up in the real world? Let's move on and meet the Q5 model, which is the practical tool these researchers built to put their theory to the test. So, the Q5 model looks at 5 key things to explain stock returns. A couple of them are pretty standard: the overall market direction and the company's size. But it's the next 3 that are the real secret sauce. Coming straight from that new theory we just talked about, we've got profitability and expected growth, which together measure a company's quality. And then we have investment, which helps us spot a bargain. Remember, low investment from a great company can be a signal that it's undervalued. These 3 new factors are really the engine of this whole thing. All right, so this is the moment of truth. Does this model actually work? Can it systematically explain the success of some of these famous investing strategies that for years have felt, well, like magic? Let's put it to the test. First up, Joel Greenblatt's famous magic formula. The idea behind it is so simple and powerful, it's beautiful. It just looks for good companies measured by a high return on capital that are also selling at bargain prices, measured by a high earnings yield. It's a classic value investing strategy. So let's see how the magic formula did. If you look at that first row, it delivered a really solid 0.41% average return per month. Pretty good. But, and this is the key, what happens when we check to see how much of that is true, unexplained skill, what we call alpha? Well, look at that second row. After we run it through our Q5 model, the alpha is actually negative 0.13%. What that means is once you account for the factors of profitability and investment, the magic completely vanishes. The strategy actually did a tiny bit worse than the model predicted it would. And this chart just makes it crystal clear. That big first bar, that's the nice return the formula generated. But that tiny little bar next to it, that's what's left over after our Q5 model is done explaining things. The magic wasn't really magic at all. It turns out Greenblatt's formula was just a really smart, systematic way of buying highly profitable companies that weren't investing a lot, which is exactly what our new economic theory says should earn higher returns. Okay, next up, we've got a strategy from the firm AQR called Quality Minus Junk. And yeah, the name pretty much says it all. The strategy is to buy a basket of high-quality companies, ones that are profitable, growing, and safe, and at the same time, short sell a basket of low-quality or junk companies. And would you believe it? It's the exact same story all over again. The strategy produced a nice 0.22% average monthly return, but how much of that was genuine, unique alpha? After we run it through the Q5 model, that return shrinks down to almost nothing, just 0.04%. Again, what looks like a really clever, sophisticated strategy is actually just capturing the predictable returns that our model says should come from buying high-quality, profitable, growing companies. So the model can explain these quantitative formulas, no problem. But what about the ultimate test, the final boss, if you will? Can it explain the master of fundamental gut instinct investing? In our last section, we're going to turn the Q5 model on Warren Buffett himself.
This really is the big one, isn't it? Can a purely numbers-based quantitative model explain any part of the legendary performance of Berkshire Hathaway, which is run by maybe the most famous non-quantitative fundamental investor of all time?
First, let's just take a moment and let the scale of his success sink in. From way back in February 1968 all the way to the end of 2020, Berkshire Hathaway delivered a staggering average monthly excess return of 1.41%. That is just an unbelievable, sustained performance over more than 50 years. It's legendary for a reason.
And here is the jaw-dropper. The Q5 model can actually explain more than 58% of that legendary return. So how is that possible? Well, the data shows that Berkshire Hathaway's portfolio has consistently, for decades, been tilted heavily toward the model's key factors, high profitability and low investment. In other words, for over half a century, Buffett has been systematically buying high-quality companies at bargain prices. Now, to be clear, there's still an incredible 42% of unexplained alpha left over, and that is the true Buffett genius. But it is absolutely amazing that a model can explain more than half of his performance by just applying these core economic principles.
So this leaves us with a really fascinating question to chew on. If a systematic economic model can explain a huge chunk of what we've always just called pure, inimitable genius, then what does it really mean to be a great investor today? Maybe, just maybe, it's less about finding those one-off magical unicorn stocks and more about having the incredible discipline and the deep insight to consistently identify and stick with the fundamental characteristics of quality and value, because that's what truly drives returns, year after year, over the long haul.